Here's a weird accounting rule for you. Unpaid invoices don't reduce revenue in the P&L. Why is it that you can sell lots of bad contracts, never get paid, write them off, and both revenue and gross profit remains unaffected? To understand why the P&L differs from the economic reality, we need to understand the accounting of what happens when a customer doesn't pay you. There are three key concepts that we will walk you through, starting with allowance of doubtful accounts, then impairments of receivables, and third and finally, bad debt and account receivable write-offs. First up is allowance of doubtful accounts, as called under US GAAP, or provisions for bad debt, as it's called under IFRS. Think of these as a proactive estimate of the portion of your receivables that you might not collect. This is done upfront at the beginning of each reporting period. The journal entries goes as follows. Debit, bad expense in the P&L. This typically sits in the P&L as an operating expense under general and administrative costs. Credit, allowance of doubtful accounts, which is in the balance sheet. This is a contra asset account that reduces the total amount of accounts receivable. So how do you estimate these provisions? Well, the simplest way is to use a percentage of credit sales based on historical data. The slightly more complex but more accurate way is to start by dividing your accounts receivable into aging balances and apply loss rates for each aging bracket based on historic data. Usually 0 to 30 days has between 0 and 1%, 30 to 60 days between 2 and 5%, 60 to 90 days has between 10 and 25%, and receivables that are more than 90 days overdue often have loss rates of over 50%. This really shows the importance of solving issues that are blocking payments faster. If you let your receivables sit, the likelihood of collecting absolutely plummets. Now let's talk about impairments on accounts receivable, or expected credit losses, as it's also called. The purpose of impairments is to adjust the value of outstanding receivables to reflect what realistically you can expect to collect. This is done at the end of each reporting period, and it's basically adjusting the allowance for bad debt to reflect what you realistically expect to collect. If you expect your credit losses to be higher than your allowances, you record impairments, which increases the allowance for bad debts. The journal entry goes as follows. You debit bad debt expense in the P&L, again in the operating expense under general and administrative expense, and you credit allowances for doubtful accounts on the balance sheet, just like you did in allowances of bad debt. If, on the other hand, you expect your credit losses to be lower than your allowances, you should record a reversed impairment. This is the opposite. So you credit bad debt expenses in your P&L, and you debit allowance for doubtful accounts on your balance sheet. And finally, let's talk about bad debt, accounts receivable write-offs. This is the last step in the process. Bad debt is money you accept that you will not be able to collect. This happens when all reasonable efforts to recover it has failed. Maybe the customer went bankrupt, disputes were never resolved, or collections are simply unrealistic. So how do you treat this in the books? Well, if you have recorded allowances already, the AR write-offs does not impact the P&L. This is already expensed from the allowances. The journal entries simply reduce the allowances and removes the receivable, impacting only the balance sheet. So you debit allowances for doubtful accounts on the balance sheet, and you credit accounts receivable. If the bad debt write-off exceeds the existing allowances, you must increase the allowances to cover the shortfall via impairments as described in the previous section. So, accounting treatments aside, what can you do operationally to reduce bad debts? Most finance teams only pay attention to bad debt after invoices are overdue, but the risk actually starts much earlier. The key is to solve issues that block payment faster. As we saw in the first section, the likelihood of recovering receivables drastically decreases over time. Here are my 3 top tips to reduce bad debts. Number 1, automate queries in your finance inbox. Many overdue invoices are blocked by simple billing questions that sit unanswered in shared inboxes. Using AR automation tools like Paraglide can help you fly through these queries and solve issues faster. 2, escalate to the right contact person at the company, not just the billing email. 3, follow structured debt recovery processes. So this is where tools like Paraglide can help, by using AI agents to manage your accounts receivables and collection process. If this was helpful, like, share, and subscribe for more practical insights for finance leader, and I'll see you in the next Paraglide Accounting Corner. Thank you.